In 1988, an investor put $10,000 into Coca-Cola stock and walked away. No day trading, no panic selling, just patience. Today, that same investment pays out over $12,000 every single year in dividends alone. That's before you even count the stock price appreciation. This is the story of the most powerful wealth-building tool most investors completely ignore. And by the end of this video, you'll know exactly how to use it. Let's start with the basics, because most people think they understand dividends, but they don't fully grasp what makes them special. A dividend is a cash payment that a company makes directly to its shareholders. You own a piece of the company, and the company shares its profits with you. Simple enough. But here's what changes everything: the consistency. We're not talking about one lucky bonus. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola have been increasing their dividend payments every single year for over 50 years straight. Through recessions, through market crashes, through pandemics, they kept paying and raising those dividends. These companies are called dividend aristocrats if they've raised dividends for 25 consecutive years, and dividend kings if they've done it for 50 or more. The reason most investors overlook dividends is that they're not exciting. There's no viral story, no overnight millionaire. The media doesn't cover a company quietly raising its dividend by 6% per year. But Wall Street insiders understand something retail investors don't: that boring, consistent cash flows are the foundation of serious, lasting wealth. Think about this. The S&P 500 index has returned an average of around 10% per year historically. But roughly 40% of that total return has come from dividends, not stock price appreciation. That's nearly half your total gains coming from income you could use right now, or reinvest to accelerate your growth even faster. Now, here's where dividends stop being just interesting and start being truly life-changing. The secret isn't just collecting dividends. The secret is reinvesting them. When you use a dividend reinvestment plan, often called a DRIP, every dividend payment you receive automatically buys more shares of that stock. More shares means more dividends. More dividends means even more shares. And it feeds on itself, compounding over time like a financial snowball rolling down a hill, growing faster the further it goes. Let's make this real with some numbers. Imagine you invest $20,000 in a company with a 4% dividend yield. In year one, you collect $800 in dividends. You reinvest all of it, now owning slightly more shares. In year two, those extra shares generate slightly more dividends. You reinvest again. Over 30 years, assuming the stock price stays flat and the dividend is steady, which in reality, dividend growth stocks typically raise their dividend by 5 to 8% per year, your $20,000 investment could grow to over $65,000 through compounding alone. Add in modest stock price appreciation and a steadily growing dividend, and you're looking at multiples of that. The rule of 72 is a quick way to understand this. Divide 72 by your annual return rate, and you get the approximate number of years it takes to double your money. At 8% returns, a reasonable blend of dividend income and modest growth, your money doubles roughly every 9 years. Invest at 30 years old, and by retirement you could see 5 or 6 doublings. That $20,000 becomes $65,000, then $130,000, then $260,000, compounding silently in the background while you sleep. Not all dividend stocks are created equal. In fact, chasing the highest dividend yield is one of the most dangerous mistakes you can make. Here's why. A 10% dividend yield sounds incredible, right? But ask yourself, why is the yield that high? Often it's because the stock price has collapsed and the company is in financial trouble. That sky-high yield is a warning sign, not a gift. The real metrics you want to evaluate are dividend yield, dividend growth rate, and payout ratio. Dividend yield tells you what percentage of the stock price you're receiving as cash annually. A sustainable range for most quality companies is between 2 and 5%. Dividend growth rate is how fast the company is increasing its dividend each year. Companies growing dividends by 7 to 10% annually will double your income every 7 to 10 years, even without adding new money. The payout ratio is perhaps the most important safety check. It measures what percentage of earnings the company is paying out as dividends. A payout ratio below 60% means the company has plenty of room to maintain and grow dividends, even if earnings temporarily dip. Above 80%, and any earnings slowdown could force a dividend cut. When looking for candidates, start with the Dividend Aristocrats list. Those companies in the S&P 500 that have increased dividends for at least 25 consecutive years. Within that list, look for sectors you understand. Consumer staples like food and household products, healthcare companies, utilities, and quality financial institutions. These are businesses that sell things people need regardless of economic conditions, which is exactly why their dividends remain reliable across market cycles. Now let's talk about actually building this portfolio in the real world. You don't need $100,000 to start. You don't need a financial advisor charging 1% of your assets. You need a brokerage account, a clear strategy, and consistency. Start with diversification across at least 8 to 12 individual dividend stocks, or use a dividend-focused index fund or ETF as your foundation. Funds like the Vanguard Dividend Appreciation ETF or the iShares Select Dividend ETF give you instant exposure to dozens of quality dividend payers with a single purchase. If you prefer individual stocks, spread across at least 4 to 5 sectors. Healthcare, consumer staples, financials, industrials, and utilities make a strong core. This diversification protects you if one company cuts its dividend or one sector underperforms. The strategy that consistently outperforms is dollar cost averaging, investing a fixed amount every single month, regardless of market conditions. When prices are down, your money buys more shares. When prices are up, you're still building. Over time, your average purchase price smooths out and you avoid the trap of trying to time the market, which even professional investors consistently fail at. Set up automatic dividend reinvestment. Let the system work for you. Review your portfolio once or twice a year, not once or twice a day. The psychological edge of dividend investing is enormous. When markets crash and stock prices fall, your dividend income often stays the same or even grows. That income gives you confidence to hold or even buy more when panic sellers are dumping quality assets at discounts. Now, before we close, let's cover the mistakes that destroy dividend portfolios, because avoiding mistakes is just as important as making the right moves. Mistake number 1, chasing yield. We touched on this, but it bears repeating. A 12% dividend yield is almost always a trap. Do your payout ratio homework before you buy. Mistake number 2, ignoring dividend growth. A 2% yield that grows at 10% annually will outperform a 5% yield that stays flat within about 7 years. Always prioritize growth rate alongside starting yield. Mistake number 3, not reinvesting. Every dollar of dividends you spend rather than reinvest is a dollar that doesn't compound for you for the next 20, 30, or 40 years. The difference between reinvesting and spending dividends over a 30-year period is often the difference between financial freedom and financial regret. Mistake number 4, selling during corrections. Market downturns are when dividend stocks go on sale. A company paying a 4% yield when the stock is at $50 is now paying 6% when the stock drops to $33. That's an opportunity, not a reason to panic. Dividend investing isn't glamorous. It won't make you rich overnight, but done consistently, with patience and discipline, it's one of the most reliable paths to building real, lasting wealth. The kind that grows while you sleep, pays you during recessions, and compounds into genuine financial freedom over time. If this kind of in-depth investing education is what you've been looking for, hit subscribe. Every week we break down the strategies, the stocks, and the systems that serious investors actually use. Your financial future is built one decision at a time. Make this one count.